Subcommittee on Housing and Insurance will come to order. Today's hearing is entitled Sustainable Housing Finance, Private Sector Perspective on Housing Finance Reform, Part 4. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Without objection, members of the full committee who are not members of this subcommittee may participate in today's hearing for the purposes of making an opening statement and questioning our great panel of witnesses. The chair now recognizes himself for 3 minutes for an opening statement. I first want to welcome our panel and thank them for participating in today's hearing on housing finance reform. We've had many. I don't know if you've followed all of them, but this is of particular interest to us today on this topic. We have witnesses that offer credit enhancement products and participate in credit risk transfers. As we look to reform the housing finance system, I hope to explore whether they can play a larger role in this space as we move forward. Expansion of private sector capital into the housing finance system should be a key goal of any restructuring of our housing finance. We've seen how successful these products have been in offloading risk in recent years, and the federal government has engaged in these products and programs to some extent. Now, Fannie, Freddie, and Ginnie themselves use forms of credit risk enhancements in the present day to offload their risk to the private sector, and I look forward to hearing from our witnesses about how the various programs work to help relieve the burden of our taxpayers should we see another malfunction in our housing finance market. These programs and products include mortgage insurance and credit risk transfer programs such as Structure Agency Credit Risk, or STACR, and Credit Insurance Risk Transfers, or CIRT. I think it's important to note that just yesterday, FEMA announced that in the NFIP program, they will recover over $1 billion in reinsurance coverage under their 2017 reinsurance program. Seems like the program actually worked. Wow. Maybe we can learn lessons from what FEMA did and apply this in the housing finance space. And it could bode well not just for homeowners, for the private sector, but man, would it be cool if it worked well for the taxpayer too. Everyone could be a winner. Seen as the first reinsurance purchased by the federal government has borne fruit in terms of a successful transfer of risk, I'm interested in hearing how reinsurance already plays and can play an increased role as we look at offloading risk in the housing finance space. As with any private sector capital product, we must look at the availability of coverage or capacity and the impact of cycles on these products. While I believe these products will ultimately help bring in capital to the housing finance system, we must make sure taxpayers are protected and not left holding the bag in economic downturns. And so I want to reemphasize that we must look at ways to make sure that the housing finance system relies primarily on private capital and utilizes the tools and products that are available. Development in this space is an example of how the private sector will react and develop in a free market and fill the void the government, I don't believe, can fill. With that, my time just now expired, so I recognize the ranking member, the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman, and thank you, panelists, for being here. We have in you a wide variety or a wide array of stakeholders and individuals who can perhaps help us as we deal with this issue, because one of the things that is troublesome to me is that we are seemingly just holding on and keeping Fannie and Freddie in conservatorship, and I don't think that to do so is sustainable. I don't think that it is prudent. And as one who was here when this was done, I can tell you I don't think there was anybody on this committee who believed that that was a permanent arrangement, but it's moving along as if it is. And so today our hearing is going to focus on private capital, credit risk, and credit enhancement, as well as the steps that the FHFA has undertaken in the past few years to transfer the risk and assets and new ways to do so as we move toward the end of one year and into a new year. Right now, according to the most recent progress report from FHFA, since 2013, the enterprise transferred a portion of the risk on $1.8 trillion of unpaid principal balance with a combined risk in force of about $60.6 billion or 3.3% of UPB. And so I want to discuss with those of you who have been kind enough to come, find out whether or not you believe that these steps have had and will have a positive impact on the overall housing finance system. And it would be helpful, at least to me, to hear how different kind of risk transfers, such as the front-end credit risk transfers, would affect the housing system. Last week, we held a hearing. The acting president of Ginnie Mae provided testimony, and he proposed a housing finance reform plan that would rely on Ginnie Mae as the centerpiece of the housing finance system. And this proposal would also introduce private credit enhancers to compete with the federal agencies in taking on some of the credit risk. And so I'm hopeful that you will be willing to share your views on the proposal, as well as discuss the impact that such a proposal would have on small lenders and the issue that I am extremely concerned about, affordability. The path to housing finance reform may not be easy. Well, it's not going to be easy. But I am encouraged, and I say this every place, because I think we are having a robust bipartisan dialogue, and I feel very good about it. So thank you for being here today, and we look forward to you solving most of the problems that we have before us.
The gentleman yields back. The chair now recognizes the vice chair of the committee, the gentleman from Florida, Mr. Ross, for 2 minutes.
Thank you, Chairman, and thank you again for holding another hearing on this important issue, and also thank you to our great panel of witnesses for sharing your insights with us this morning. We want all home ownership to be more affordable, but affordability isn't just for home buyers eager to own a part of the American dream. If the government is involved, we need to make it affordable for taxpayers too. Today, we will examine the financial tools that allow Fannie and Freddie to take such a balanced approach. It wasn't long ago that Fannie and Freddie took major risks in the housing market. Reasonable minds may disagree about the impetus for that risk, whether it was overzealous profit-seeking or, as I believe, misguided government policy. But regardless, one thing is clear. The result was a systemic calamity that reverberated throughout the world economy. Those homeowners we were trying to help were ultimately hurt. Many couldn't afford to stay in their homes, and taxpayers could barely afford to bail out Fannie and Freddie. Fortunately, there's a smarter way. You see, many Americans think of risk as a feeling or a worry, but it's not. It's a way of looking at an investment that ensures we consider the context of that investment. What's the likelihood something will fail? High, low? If we're guessing, we're losing. Thankfully, we've inherited an intellectual tradition that allows us to calculate our likelihood of success and transform the threat of failure into a commodity. I bring this up because I think there's something to be applauded in the new approaches Fannie and Freddie have taken into managing risk. During the financial crisis, most lawmakers were taken by surprise because they were completely unaware of the risk our GSEs took on. They were also surprised because there didn't seem to be a way of effectively mitigating that risk as it stood. One might even say that the risk management strategy was, quote, if something goes wrong, the taxpayers will pony up, unquote. This implicit taxpayer insurance was opaque. It was a moral hazard, and we're done with it. We are developing new and better approaches that take into account the realities we face today and pave the way for a better tomorrow. The credit risk transfer programs we will discuss in this hearing are a remarkable demonstration of how markets and human entrepreneurship can solve many of the problems created or made worse by the government. I am excited that today we will talk about how your organizations participate in that conversation and make it so that our housing market continues to thrive and our taxpayers aren't on the hook. I yield back.
The gentleman yields back. We now welcome our witnesses here today. And by way of introduction, our first witness is Mr. Michael Cantor, Director of U.S. Multi-Sector and Securitized Assets at AllianceBernstein. Welcome. Our next witness is Dr. Susan Wachter, Professor of Real Estate and Finance at the Wharton School at the University of Pennsylvania. Next we have Mr. Jeffrey Cron, Managing Director at Guy Carpenter and Company. Welcome. Our fourth witness is Mr. Andrew Rippert, CEO of Global Mortgage Group at Arch Capital Group. Welcome. And finally, last but not least, our fifth witness is Mr. Patrick Sinks, the CEO of Mortgage Guaranty Insurance Corporation, or MGIC, headquartered in the greatest state in the nation, Wisconsin. Welcome, all of you. In a moment, the witnesses will be recognized for 5 minutes to give an oral presentation of their testimony. Without objection, the witnesses' written statements will be made part of the record following your oral remarks. Once the witnesses have finished presenting their testimony, each member of the subcommittee will have 5 minutes within which to ask all of you questions. You'll note that on your table you have 3 lights. Green means go, yellow means you have 1 minute left, and red means your time is up. We'll try to be cognizant on our end of the time, but please on your end too, try to be aware of those times and lights. Your microphones are sensitive, so please make sure you're speaking directly into them. And so with that, Mr. Cantor, you are recognized for 5 minutes. Could you turn your microphone on just as a...
Yeah, good morning.
There we go, that's better, we can hear you.
All right. Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to testify before you today. My name is Michael Cantor, and I am the head of securitized assets at AllianceBernstein, also known as AB. At AB, we manage over $500 billion of assets on behalf of many different types of investors, ranging from individuals and retail mutual funds to pension funds, insurers, and global corporations. I am appearing here today on behalf of AB and not any specific trade group, that we are members of SIFMA and the Association of Mortgage Investors. AB is one of the largest investors in the credit risk transfer market, and I hope that our experience will be helpful to the subcommittee and the important work that it is doing. Today, the CRT market has $40 billion of securities outstanding, referencing over $1.3 trillion of mortgages. That's 32% of the GSE's overall mortgage exposure. In fact, 50% of all GSE mortgages created today go into CRT transactions. So without a doubt, the CRT bond market is crucial to how mortgages get financed in the country. CRTs also play a prominent role in many GSE reform proposals. The fact that the GSEs have multiple ways to hedge their risk is important, and all of them have value. But we see the fixed income market solution as the cornerstone to any system going forward. I'll highlight a few reasons why. First, a CRT bond is fully funded at issuance, so the GSEs do not have any counterparty risk. There is no risk of non-payment. In contrast, there are some proposals that urge greater use of mortgage insurance, sometimes called deep MI. It is important to remember that the ability and willingness of MI companies to pay claims becomes highly questionable in times of stress. It certainly did during the crisis. The GSEs already have $200 billion of counterparty exposure to the MIs. Deep MI would only increase that. Also, once risk is in bond form, it can be distributed across a wide swath of investors and included in diversified portfolios across the globe. This is not the case for mortgage insurers, of which there are 8, whose entire levered capital base of $12.5 billion is exposed to mortgage losses. Lastly, CRT bonds pay claims immediately, whereas recouping MI payments can be a long, drawn-out process involving negotiation and sometimes litigation. So what are the key attributes needed to perpetuate the success of the CRT market in a new housing finance system? The first I'll mention is the ability of the GSEs to take risk alongside of investors. This alignment of interest has been crucial to investors' comfort in buying CRT securities and is a must-have in any new system. This is especially true when transferring first loss risk. There is an abundance of capital willing to take this first loss risk with the right structure and risk sharing by the GSEs. Second, the GSEs are trusted by investors for the power they have in not only setting underwriting and servicing standards, but ensuring that they are enforced. Confidence in any guarantor's ability to do this is essential. Such confidence, however, may be difficult for new guarantors to replicate. Thirdly, there has been a healthy competition between the GSEs to attract investor dollars. This dynamic allowed for innovation and kept the GSEs open-minded to investors' needs. In my view, there is no magic number of guarantors for a new system, but I think it is probably safe to say that it is greater than 2. Lastly, I would state that the FHFA has been very effective at encouraging risk transfer to protect the U.S. taxpayer. We think the lesson learned here is that it may be best for policymakers and regulators to avoid being overly prescriptive. Instead, a thoughtful capital framework needs to be put in place that puts a high value on risk transfer. All this being said, I'd like to mention 2 ways the CRT market could be improved. First, the broker-dealer capital charge for holding and trading these securities is unnecessarily onerous at 100% or greater. This is detached from the risk in these bonds and does nothing to help support the housing market. Second, the GSEs need to more rigorously evaluate and perhaps separate out the natural catastrophe risk that is embedded in CRTs. If homeowners default on their mortgages because of a flood, hurricane, or earthquake, any resulting loss flows through to the CRT structure. This may be good for the taxpayer in the short term, but I would venture to say that these risks have been woefully undermodeled and underconsidered by the GSEs and the rating agencies. In conclusion, I want to thank you all for proceeding with this critically important reform effort, and we at AllianceBernstein stand ready to assist the subcommittee in any way we can, and I look forward to answering your questions.
Thank you, Mr. Cantor. Ms. Wachter, you're now recognized for 5 minutes.
Good morning, Chairman Duffy, Ranking Member Cleaver, and other distinguished members of the subcommittee. Thank you for the invitation to testify at today's hearing. I am the Sussman Professor of Real Estate and Professor of Finance at the Wharton School of the University of Pennsylvania. It is an honor to be here today to discuss the future of the housing finance system and the role of credit risk transfers in helping to assure a stable and sustainable housing finance system going forward. In the past crisis, the housing finance system failed borrowers and taxpayers, and it is important to understand why. We now know, but did not know, the shift toward unsound lending as it happened. The bubble in housing prices that the expansion of unsound credit enabled masked the increase in credit risk. The failure to identify credit and systemic risk must be corrected going forward. Credit risk transfer programs, if properly structured, can help. Securities trading can discourage excessive borrowing if credit risk is priced accurately, and in this way counter housing bubbles. Securitization markets, including the over-counter market for residential mortgage-backed securities, failed in the run-up to the crisis. Beginning in 2013, under the direction of FHFA, the GSEs have developed credit risk transfers to share and trade credit risk. How CRTs are structured matters greatly to their potential role in reducing systemic risk. In addition, the eventual reform of the housing finance system will influence how well the CRT markets work, or even whether the market can work at all. What is necessary for the structuring of credit risk transfers, and more generally, for the reform of the GSEs to enable the CRT market to inform on credit risk going forward? First, is the direct linkage of CRT's performance to the risk of default of the underlying mortgages. This is in place. In addition, the use of a reference pool allows the so-called TBA market to trade and efficiently price interest rate risk, which is important separately from the pricing of credit risk. A second requirement to avoid the pitfalls of the past mispricing credit risk is transparency and standardization to allow the identification of aggregate credit risk. The full provision of information on mortgages in the GSE portfolios referenced by CRTs does this as well. Third, to avoid counterparty risk, credit risk transfers must be structured so that in the event of losses, funds are transferred and available to be transferred automatically. This is achieved now also in the so-called back-end credit transfers by writing down the outstanding principal balance of the CRT securities, thereby reducing the amount the GSEs are obligated to repay to holders of CRT securities. Fourth, there needs to be trading of the credit risk instruments with open pricing and liquid markets, unlike in the crisis, where credit risk instruments traded over the counter and infrequently. This, too, is in place. Currently, CRTs provide information on how markets price credit risk without mandatory linking of G-fees to credit risk trading pricing, and without mandating the level of use of CRTs by the GSEs. Both are important to market stability. While the performance of CRTs should be linked to the underlying performance of mortgages in the reference pool, as it currently is in back-end credit transfers, the pricing of CRTs should not determine G-fees or mortgage interest rates. In a period of market stress, investors in CRTs are likely to pull back. If so, interest mortgage rates, if automatically linked, would have to rise, and this would cause a decline in housing prices. And that would, in turn, cause a pullback in credit and a follow-on decline in housing prices and a reinforcing cycle, as we saw in the crisis. The discretionary setting of G-fees over the cycle is necessary to avoid reintroducing market instability. For the same reason, the use of CRTs should not be mandatory. That is, their use should be discretionary. Mandatory risk sharing is an inefficient policy, as it encourages transactions where the cost of the risk transfer is greater than the cost of the GSEs retaining the risk, thus potentially raising the cost of mortgage lending. Currently, the trading of CRTs provides information about what private market capital markets would trade for the credit risk generated by the credit guarantee business of the GSEs. But it is not automatically linked to G-fees. G-fee is set administratively with significant guidance from the FHA. This should not change. The structure of the housing finance system itself is important to the functioning of CRTs. If there are many guarantors, each with its own CRT market, such markets would not be liquid. Moreover, with many entities, each setting its own standards and its own G-fees, even with the guidance of FHA, there would be a tendency to compete over the standards and undermine them over time. The pricing of housing finance should be set over the cycle, and standards should be maintained over the cycle as well, to limit risk and to provide sustainable housing finance for the long term. I thank you for the opportunity to testify today, and I welcome your questions.
Thank you, Mr. Crone. You're now recognized for 5 minutes.
Chairman Duffy, Ranking Member Cleaver, distinguished members of the committee, it is an honor to have the opportunity to provide this testimony regarding the sustainability of housing finance. My name is Jeff Crone. I lead the global mortgage credit practice at Guy Carpenter. Our company is part of the Marsh & McLennan Companies and occupies a unique position within the mortgage credit reinsurance market. In my role, I oversee all client relationships with our GSE clients, Fannie Mae and Freddie Mac, and our global mortgage insurance clients. Separately, our organization is the broker for FEMA's National Flood Insurance Program. This program was put into place last year and proved to be a success by responding to Hurricane Harvey and reduced the burden to the taxpayer by over $1 billion. Today, the U.S. economy enjoys a very strong housing market. However, the last financial crisis revealed the GSEs and private mortgage insurers carried all the weight of the losses caused by borrowers that could not make their mortgage payments. As a result of the crisis, material reform has taken place. The most notable change occurred in 2013 when the FHFA mandated Fannie Mae and Freddie Mac to initiate a credit risk transfer program that de-risked their portfolios and protected the U.S. taxpayer by introducing private bond investors and multi-line global reinsurers into the system. Today, reinsurers, bond investors, and private mortgage insurers provide the GSEs with a counter-cyclical force that sustains the housing market during uncertain times. The reinsurance market represents a significant and attractive source of private capital for the GSEs because the industry bears a small amount of U.S. residential mortgage risk, and its other forms of risk are not correlated to mortgage credit risk to any meaningful degree. AM Best's top 50 reinsurers have $727 billion of capital, and the stability of the reinsurance market has stood the test of time. Before, during, and after the crisis, the composite ratings of core reinsurers writing mortgage credit have remained strong and within a very narrow band of S&P ratings between A and A+. The recent $73 billion in industry losses from this year's hurricanes, wildfires, and earthquakes have not impacted pricing or available capacity for the various GSE and mortgage reinsurance placements. The reinsurance market will continue to be an attractive and significant source of private capital for years to come. The Federal Housing Administration's mission is vitally important to first-time home buyers, low-income borrowers, and consumers with limited credit history. But it is not a mission without risk for the U.S. taxpayer. The FHA's mission leads it to provide broader coverage on a pool of loans that is riskier than those of the GSEs, and the FHA lacks a credit risk transfer mechanism. The FHA capital requirements to support portfolio risk remain low. The latest actuarial report estimates the Mutual Mortgage Insurance Fund to be at 2.09%, just above the minimum 2% threshold. Guy Carpenter believes the FHA should fully explore ways to introduce private capital to effectively manage its credit risk and fulfill its mission. Private capital will introduce a market-like view of FHA's portfolio and provide valuable insights. Real-time pricing discovery and feedback could be incorporated into the FHA's insurance premium rates, underwriting, and loan programs, the result of which would make a more stable and predictable mutual mortgage insurance fund. Guy Carpenter's mission remains to develop broad and diversified reinsurance markets that reduce taxpayer risk, maintain liquidity, and help to build a strong housing finance system. Credit risk transfer has the interest of the American people at heart and will ensure continued access to affordable credit to underserved borrowers and act as a countercyclical force that sustains the housing market in uncertain times. Thank you again for the opportunity to provide this testimony.
Thank you. Mr. Rippert, you are recognized for 5 minutes.
Chairman Duffy, Ranking Member Cleaver, and members of the subcommittee, thank you for the opportunity to testify. My name is Andrew Rippert, and I am the CEO of Arch Capital Group's mortgage operations. In this role, I am responsible for the global mortgage guarantee and credit risk transfer business of Arch, with an emphasis on the U.S. housing market. This includes Arch MI, the largest private mortgage insurer in the country. More importantly, Arch Capital Group is committed to expanding sustainable home ownership and affordable lending. Housing finance reform legislation has the potential to increase private investment, economic growth, and the availability of mortgages for creditworthy borrowers. The continued conservatorship of the GSEs increases systemic risk and policy uncertainty. These issues are keeping private capital on the sidelines and have contributed to a more anemic housing recovery and lower home ownership levels than we might have otherwise experienced. Legislative reform will help ensure that the system is prepared to handle an eventual and an inevitable market downturn. The work done to diversify risk through the CRT programs developed by the enterprises with the support of the FHFA has been significant in bringing private capital to the market. In fact, Arch has been a major supporter of and participant in CRT through our reinsurance operations. Arch recommends that the GSEs continue to innovate and expand on the available risk transfer structures. Additionally, legislation is needed to codify these policies and ensure that programmatic CRT is a permanent feature of the housing finance system. It is critical to lock in the advances made over the past 5 years to avoid the possibility of reverting to previous counterproductive norms and ensure the permanency and consistency of these programs. Existing CRT programs have reduced taxpayer exposure and provided important diversification of private capital sources. But the GSEs still hold significant first loss exposure concentrated on 2 highly leveraged balance sheets with an implicit taxpayer backstop. This structure needs to change to institute an explicit government guarantee at the security level, expand to include multiple guarantors, and ensure that private capital is positioned ahead of taxpayers in a meaningful way. Until structural changes are made to the guarantor model, the GSEs should continue to expand their use of back-end and front-end CRT transactions with reinsurers, mortgage insurers, and capital debt markets. There are a variety of CRT options available to the enterprises that offer practical and cost-efficient ways to transfer risk that have yet to be implemented. Reinsurers, in particular, offer a highly rated pool of capital that is dedicated to housing finance reform on a long-term strategic basis. They broaden the base of available capital and provide greater taxpayer protections. The most important thing that Congress can do from Arch's perspective to encourage the return of private capital is to make programmatic CRT a permanent feature of the housing finance system through legislation. With CRT assured as a permanent feature, private capital will make the necessary investments to underwrite mortgage credit risk across all market conditions. This will also provide regulators and policymakers with tremendously valuable, well-informed, and timely feedback on both the level of risk in the market and the economic cost associated with that risk. Reforming the U.S. housing finance system calls for a significant volume of private capital. Arch believes that if Congress were to enact legislation passed on the following key factors, additional private capital will be drawn into the system and promote a greater level of market certainty and sustainability. First, we need to position private capital ahead of taxpayers in a meaningful way. Second, we need to establish a regulatory framework that requires mortgage guarantors to follow a counter-cyclical capital model that is responsive to the dynamic nature of housing market risk. Third, require mortgage guarantors to follow an accumulate-to-distribute model that programmatically moves risk to diverse pools of private capital. Fourth, require additional transparency into the cost of credit risk as identified through CRT and its relationship to guarantee fees. And finally, reform the FHA to eliminate negative competition between the enterprises and the FHA programs. Thank you for the opportunity to testify. Arch is committed to working with this committee. I look forward to answering your questions.
Thank you. Mr. Sinks, you are recognized for 5 minutes.
Chairman Duffy, Ranking Member Cleaver, and the members of the subcommittee, thank you for this opportunity to come before you to discuss the housing finance system and opportunities for reform. This year marks the 60th anniversary of the modern-day private MI industry when my company, MGIC, was founded by Max Carl as a private sector alternative for borrowers and lenders to the government-backed mortgage insurance provided by the FHA. We also appreciate the opportunity to provide you with our experience of being providers of first loss, credit risk transfer, and recommendations for encouraging use of loan-level credit enhancement like MI in the mortgage finance system. While I will focus nearly exclusively on the value and role of MI in my testimony, I will note that we believe in a future system of housing finance where there will be enough credit risk transfer that there will be a need for a variety of types of private capital, each playing a unique role. Private mortgage insurance's unique loan-level approach shields taxpayers from mortgage-related credit risks while ensuring creditworthy borrowers have consistent access to mortgage financing. Over the last 60 years, MI has helped more than 25 million families attain homeownership in a prudent and affordable manner, the majority of whom were first-time homebuyers, and more than 40% have incomes below $75,000. In my written testimony, I have covered a number of issues related to the MI industry, but here I will focus on 3 important attributes of MI that are critical to any housing finance system: flexibility, stability, and reliability. First, flexibility. Private mortgage insurance is typically provided at the individual loan level at the same time as the loan is originated. The mortgage insurance protection travels with the loan wherever it goes, whether that is onto a lender's balance sheet, sold to an investor, or placed into a securitization pool. As a result, private MI is fully compatible with the broadly shared goal of a housing finance system with multiple funding sources, a feature that distinguishes MI from other forms of credit risk transfer. It also means that MI is accessible to lenders across the country, from the biggest money center banks and non-banks to smallest community banks, credit unions, and independent mortgage bankers. And because government insurance programs like FHA are loan level as well, borrowers can easily compare mortgage offerings available to them. Over our history, we have readily adapted as the mortgage finance system has evolved from savings and loans to the GSEs and independent mortgage bankers. We are confident of our ability to continue to evolve and serve any new system that is created with virtually no disruption to the origination and servicing of mortgage loans. The ability of MI companies to scale up to cover a broader segment of the market is primarily controlled by the amount of capital they hold. That said, MI companies are no strangers to expanding or shrinking their capital to meet the need for their product and adapting to housing market trends. Since 2007, MI companies have collectively raised more than $14 billion to meet capacity, support new business, and pay claims, and we have seen 3 new companies enter the market since the crisis. In addition, we have used the same resources as the GSEs, reinsurance and capital markets transactions, to supplement our equity capital. We are confident of our ability to grow our capital, all of which will stand in front of the taxpayers to support an expanded role in the housing finance system. Next, stability. Housing and mortgage markets are, by their nature, cyclical and can produce extraordinary, catastrophic losses, both at the national and individual levels. In this type of environment, there are sound reasons for creating special monoline entities to provide coverage against that risk. The monoline regulatory regime for MI is intended to ensure the industry does not create systemic risk, even during the worst downturn. It is not because regulators and MIs do not understand the value of diversification, which is evident in our investment portfolios and our insurance in force over time and across geographies. Additionally, because MI's regulatory regime was designed with cyclical mortgage markets in mind, the MI industry has a commercial interest in remaining in markets being prepared for downturns. Indeed, this regulatory regime ensured that the MI industry continued to insure new loans and pay claims. We are not too big to fail. We provide predictability and stability to the housing finance system. And finally, reliability. Since the onset of the financial crisis, private MI companies have paid over $50 billion in claims, almost all of which directly reduced the amount required to rescue the GSEs. And during that time, MI has continuously been available at a reasonable cost in all markets across the U.S. Increased capital and operational standards in the PMI eligibility requirements, along with revised master policy terms developed with the GSEs, ensure that the private MI industry will be able to cover an even greater amount of mortgage credit risk in the next crisis. The private MI model has worked for 60 years. Each market cycle brings new lessons and adaptations, but the fundamental approach has been tested multiple times and still works. No other form of credit enhancement has a similar record of performance or resilience. Any policymaker looking at what works now for inclusion in a reform system would add MI to the list. With that said, I thank you again for the opportunity to testify and to answer your questions.
Thank you, Mr. Sinks. The chair now recognizes himself for 5 minutes to ask questions of the panel. Mr. Cantor, I don't know if you just heard Mr. Sinks' testimony, but if I read your testimony correctly, I think you said downturns MI doesn't pay. Is that correct? Is that a correct characterization? I kept you two separated, either sides of the table.
Yeah, it's certainly when there's large amounts of mortgage losses, the MI companies are going to come under stress. So I think that's just a fact. If you buy hurricane insurance from an insurance company that just insures hurricanes, do you really want to keep buying hurricane insurance from them when there's a hurricane approaching? That's sort of the issue, and that's all they do. That has a lot of value. I don't want to say that it doesn't. It has a lot of value. It's just that when we talk about increasing how much exposure Fannie and Freddie are going to have and what the best way for them to hedge their risk, the fixed income markets provide a way for them to do that without taking that counterparty risk. And that's really the key. It's not that deep MI doesn't have any value. It does, and it should be pursued. It's really a matter of when we're talking about what the cornerstone of the system is going to be, we think it should be the capital market.
Mr. Sinks, what's your pushback? Yeah, microphone.
As I said in my testimony, we paid $50 billion of claims. That it would have increased that GSE number of $189 billion by that 50. In addition to that, the MIs have paid 97% of the eligible claims coming out of the Great Recession, and the remaining 3% will be paid over time. So while there was stress and companies were impacted, at the end of the day, the claims were paid.
Okay. That wasn't my main question, but I thought it was unique. You guys had different positions here, so I thought I'd bring that up to start with. But the panel's view on the availability of private capital to assume first loss mortgage credit risk. There's been some debate on that topic. Any thoughts, Mr. Cantor?
So at the beginning of 2016, the GSEs started to hedge their first loss risk. And what I mean by first loss, it's important to understand, is that they hedged what we would call the bottom tranche of risk, meaning they pay for insurance or a bond issuance that covers them from losses starting at 0 and going up to, say, 1% or up to 4%. At the beginning of 2017, they changed that, and now they're retaining the bottom 0.5% of risk. So they're no longer hedging their first loss risk from where we sit. We think if the goal is for them to hedge as much risk away from the taxpayer as possible, they're not doing that. They're operating as if they're a finance company or a bank looking to achieve a certain return on what they think their capital is.
Anybody else? Thoughts, Mr. Rippert?
Private capital is today assuming first loss risk. Mortgage insurers assume a meaningful amount of first loss risk. They're the biggest single counterparty to the GSEs, $200 to $250 billion of limit exposure. And reinsurers, frankly, are taking first loss risk as well through quota share reinsurance programs. And frankly, they're positioned to take more first loss risk. And I think an important distinction between mortgage insurers, reinsurers, and capital markets participants is mortgage insurers and reinsurers are set up to take first loss risk on a front-end basis, to take the risk away from the GSEs before they even own the mortgage loan or at the time they purchase the mortgage loan. That's something that mortgage insurers and reinsurers can do much more effectively, frankly, than the capital markets can today.
I only have a minute left. We hear a lot of debate about when times are great, private capital is going to flow in, it's going to be wonderful, but when the cycle turns against us, everyone runs for the hills. Thoughts on that point? Any pushback on that point, Mr. Rippert?
I think that one of the biggest things keeping private capital on the sidelines is this uncertainty about is the credit risk transfer programs of the GSEs here to stay, or is it, frankly, a science experiment? Right. And if it's here to stay, private capital will make meaningful, deeper investments to understand mortgage credit risk on a more fundamental level and be there over the long term.
Even in a downturn, even in a 08S cycle. I
would give the example of reinsurance markets and, frankly, mortgage insurers as well. If you look at reinsurers as one example, they make an investment in a line of business to understand that risk and underwrite it, and they stay in it through the ups and downs. They moderate their exposure, they change their pricing, but they stay in the businesses through the cycle. The same is true of the mortgage insurers. They stay in the business through the cycle. So yes, I do completely believe private capital can do that.
My time is up, and I want to be respectful of all other members. I wanted to actually get to Mrs. Wachter's point on tying CRT pricing to G fees. I thought that was an interesting point that you made, and also the natural disaster risk separated from credit risk, which Mr. Cantor brought up in his testimony. I don't have time for that, but I look forward to working with all of you as we're trying to do a bipartisan product here on the committee. So. Thank you. My time has expired. I now recognize the gentleman from Missouri, Mr. Cleaver.
Thank you, Mr. Chairman.
For 5 minutes.
I'm struggling a little bit. A few weeks ago, I had the opportunity to spend some time with Edward DeMarco, and he talked about this, what I thought was an interesting proposal that would use Ginnie Mae as the centerpiece for the housing finance system, and then create a new kind of credit enhancer to transfer risk. Dr. Wachter, Mr. Cantor, I'm interested in your response to. Are you familiar with it at all? All right. Would you just let me know what your response is to his proposal?
Today's hearing is on credit risk transfer, and so I'd like to respond to your question in the light of credit risk transfer efficacy. And it seems to me that while competition, of course, is important in many regards, competition over standards is not helpful. So to the extent that we have many guarantors or many credit enhancers, each with its own standards, each with its own premiums, this in fact can be destabilizing. So particularly, the purpose of CRTs, from my perspective, is to complete the market, inform the market, bring information to the market. And CRTs that are tied to individual guarantor portfolios, which is my understanding of how that proposal would work, would not be very liquid, and they would not be referencing the risk of the market as a whole, nor would they actually be referencing the risk only of the particular guarantors, because the risk that's created by one guarantor affects the entire market. So that's exactly what we want to avoid. We want to have the risk transfer programs pricing the overall market risk. So one thing you could do is require all of the guarantors, all of the credit enhancers, to participate in one single credit risk transfer program and to have one single set of standards and one single set of rates. That would be very much like FHA and Ginnie Mae works now, and that would work.
Before I hear from Dr. Cantor, what's your opinion of over-collateralization as that one new standard?
So we're very supportive of the Bright DeMarco plan. We agree that there needs to be a balance between competition and underwriting guidelines, and that's really important, because if we had just one entity like some of the plans out there had envisioned, we don't think there would be enough incentive to respond to what investors need, and that could be long-term detrimental. On the other hand, if we have too many guarantors, the sizes of the deals get very small, and the capital markets find it difficult to participate. The liquidity of the bonds that we buy would suffer. And so there's this balance, and that's why I say there needs to be more than 2 guarantors in any new system. Whether it's 5 or 8, it's probably less than 10 is the way we would think about it. And the bond solution being fully collateralized is why we think it's such a key component.
So do we have too much concentrated risk? Did that play a role, you think, in the housing crisis? Dr. Walsh.
It wasn't concentrated risk, it was correlated risk. It was risk created by sectors that were underwriting unsoundly, which then pervaded the entire market. So I don't think the problem was problem of one set of standards. It was a race to the bottom. It was a race of declining standards and a race where credit was not accurately priced, was underpriced. No, absolutely not. That wasn't the problem. I'm not saying that we can't have that problem, but that wasn't what caused the crisis.
Well, the last question, I'm concerned about any kind of transfer. I mean, it's not going to be a very long process. Anybody? I mean, if we're going to transfer risk, we can't vote on it today and have that settled tomorrow. My time is out. I'd like to talk to you about it at a later time. Thank you.
The gentleman yields back. The chair now recognizes the chair of the Subcommittee on Financial Institutions, Mr. Luke DeMeyer, the gentleman from Missouri, for 5 minutes.
Thank you, Mr. Chairman, and thank the panel this morning. I want to follow up. Mr. Chairman made a good question or a good comment here, which was something I was concerned about as well. Mr. Cantor made, I believe it was, made the comment with regards to the GSEs need to take out the natural catastrophe loss risk and separate that from the credit risk. Can you explain that a little bit and what your thought process would be on that, sir?
Sure. So right now, the way CRTs are constructed, if there's natural catastrophes like Harvey, Irma, Maria, and there are resulting losses, that loss flows through to the CRT investor. If that loss happens through an MI policy, the MIs don't pay that claim if that house is uninhabitable. So from a CRT investor perspective, we're experts in evaluating mortgage credit risk. The economy.
Who pays the loss then on the mortgage insurance one?
Fannie and Freddie.
Fannie.
And eventually the CRT losses if it's part
There's
of it.
no other outside insurance like homeowners insurance or the
So,
flood insurance or whatever that
right.
takes over?
If obviously if there's homeowner insurance, great, but a lot of hurricanes are not covered by a standard policy. Earthquakes are not required to be covered by Fannie and Freddie for California. So these are risks that my insurance colleagues, I think, have spent a lot of time on. I don't think that the GSEs and the rating agency have spent enough time on. And so from my perspective, the reason why this is important is because the capital markets are investing in this because they think they're taking mortgage credit risk. We know we're also taking some natural catastrophe risk. But if losses were to happen, it could jeopardize the whole CRT market. And to me, it's much more important that the CRT market is here to absorb financial condition losses and economic losses, because there's plenty of insurance companies throughout the world that can take natural catastrophe risk. And so that's what I'm interested in, is the long-term viability of the CRT market. And I just think that this natural catastrophe risk is misplaced in CRTs. But most importantly, the GSEs need to provide us the data and analysis to really be able to evaluate it, and they haven't really done so yet.
Mr. Crone, in your testimony, maybe I misunderstood you, but you said something that FHA lacks the ability to lay off, work with CRTs to lay off some of the risk. Is that correct? Can you expand on this a little bit?
That's correct. The risk remains within the FHA. There's no mechanism to transfer out of the system to bond investors, to reinsurers. That's the way it exists today.
Okay, what's your suggestions on that?
I'm sorry?
What are your suggestions on how to solve that problem?
Well, we think, the FHA should explore credit risk transfer. There's a number of things that we think might come out of that. It should increase the availability of coverage for the FHA if it can go through the cycles. They should get real-time pricing feedback. Pricing discovery is part of the CRT process, and feedback around underwriting and the loan products offered by investors, by the reinsurance market.
Okay, during the discussion here, it seems as though the word hasn't been used with regards to the different tools with CRTs, but there seems to be, in my mind, a diversification that's necessary. But it wasn't, so there's no concentration within one particular area, whether it's reinsurance, or whether it's the bond market, or whether it's mortgage insurance. Would that be kind of the assumption that, or would that be something, would you agree with that statement? There needs to be some diversification in each one of these different types of credit risk transfers would be necessary, or do you think one entity can handle all the risk?
If I may, I'll take a shot at that. Our view is that you need to have multiple sources, which is inherent in your question. The smart people think that they're in a mature market. Private capital needs to put up about $200 to $250 billion of capital to support a multi-trillion-dollar market. I don't think there's any one execution that can consistently deliver that through all markets, good times and bad times, and thus they need to try multiple of executions, whether it's reinsurance, mortgage insurance, capital markets transactions, it's all of the above. It'll take a commitment from everybody to meet the market needs.
Do the other guys agree with that?
No.
I agree with that statement.
I agree with that statement, and I think that the most popular or the most effective source of capital, rather, at any point in time will change with conditions in the market.
Diversification is always the way you want to spread your investments. With that, Mr. Chairman, I yield back.
The gentleman yields back. The chair now recognizes the very gentle lady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Reaper, I believe that a strong and well-functioning secondary market should encourage lending to all income levels and communities. So my question to you is, what is the best thing we can do to ensure that private investors continue to invest in the secondary market? And what type of front-end or back-end credit risk transfer should we be looking at? And will that help first-time buyers or lower-income borrowers?
I believe that the best way to address affordable lending standards, low-income borrowers, is with a responsible lending platform that has three basic components. That is one of financial literacy and education to help inform borrowers that the responsibility they're taking on before they get into a mortgage product. I think that product guidelines need to be set forth that sort of put guardrails on the system, that we're not offering mortgage products to borrowers that have this concept of a teaser rate initially and then escalated cost after a period of time. These are some of the sorts of products that cause problems in the market. And I think a third element is we really need to think carefully about making mortgage loans to borrowers, especially low-income borrowers, when housing markets are overheated, housing prices are overinflated. In that scenario, based on the credit risk analytic work that we do, when borrowers get into a property that's significantly overvalued, their propensity to default, to reach financial stress, to not be able to make their mortgage payments increases dramatically, anywhere from 5 to 10-fold. And so we need to think carefully about extending mortgage credit to a borrower when prices are overheated, because this has a significant disproportionate impact, especially on low-income borrowers. I think if we have a framework like that, then private capital will show up and support that.
Dr. Watcher,
yes.
would you please respond
I
to
think that the potential for front-end discounts to be pro-cyclical is great. Therefore, at good times, the front end would be there pricing at good times, and bad times it withdraws. And in the good times, it has the potential for effectively raising prices and creating a bubble if it goes too far. That destabilizes the market, raising risk overall, and that higher risk overall will be eventually priced in and will cause less affordability. What we need is a stable system which will then be less risky so that the market pricing of that less risk makes housing more affordable. This goes in the other direction.
Thank you. Mr. Cantor, in addition to exploring various types of front-end and back-end credit risk transfers, the GSEs have also explored expanding their investor profiles in the CRTs, including REITs. What advantages do you believe expanding the investor profiles in CRTs will have? And do you believe that expanding the CRTs could disrupt the TBA market?
So, no, I think the CRT market today is functioning very well, and the TBA market is functioning very well. So as the system stands today, there are no issues with TBA or the CRT market. As one of the members mentioned earlier, the transition to a new system is extremely important, probably just as important as the system that's actually decided upon. But in terms of the REITs, the GSEs have been innovative. They've come out with a new structure that will make the CRTs more REIT-friendly. So here we're talking about mortgage REITs. So that's a dedicated pool of capital that invests in mortgage products. And so we're going to see that as positive because it brings down the cost of credit risk transfer. The more investors that there are, brings down the cost to Fannie and Freddie. And when that cost comes down, it means that potentially it has an effect on the G fee, which can affect the borrower. Or even if it doesn't do that, it means that the U.S. taxpayer is paying less for the insurance, which ultimately is good for the taxpayer.
Thank you. And I guess I'll yield back.
The gentlelady yields back. The chair now recognizes the gentleman from California, Mr. Royce, for 5 minutes.
Thank you, Mr. Chairman. In Mr. Rippert's testimony, he wrote, one of the biggest regulatory risks we see is the potential for the progress made over the past 5 years to be abandoned in the absence of statutory changes. So this is a concern I have as well. I think we've got to lock in successes and build on those successes. And so, as some of you know, Representative Gwen Moore and I have introduced legislation requiring the GSEs to maintain the credit risk transfer market while increasing the amount and types of CRT transactions. And to date, I suspect everyone on the panel would agree that Fannie and Freddie's CRT initiatives have been a success in the sense that they're decreasing exposure to unexpected loss and in turn decreasing risks to the taxpayers. We've heard more today on ensuring that CRT works as a stable source of capital through the economic cycle, even in a downturn. We need to get more institution-based capital involved. We've kicked that around. We need more players. We need mortgage insurers in this deeper. We need REITs and reinsurers, and we need to bring transparency and competition to front-end deals. So I would just ask the entire panel here, is this a laudable goal, and how do we get there? Just like to hear from you.
I think it's a very worthy goal. It aligns well with how we at Arch Capital Group think about the market and creating a more sustainable market that facilitates affordable lending to creditworthy borrowers. So we think the diversity of capital is critical because not just because at various times some capital work more efficiently than others, that is, and by more efficient I mean lower cost to borrowers, but you need it because of the amount of risk that needs to be transferred, this approximately $250 billion of risk to be transferred to private capital. I think the functioning of capital across a cycle will be very effective as well in giving feedback, this concept of price discovery that gives an indication of the level of risk in the market will be a very important feedback mechanism from all these various sources of capital as well.
If I may, I would add, I concur it is a laudable goal. I think it's necessary to have not only the variety of capital alternatives, but also the permanence of the capital. We need to know in creating a housing policy system that capital is going to be there in all markets. And so we need to clarify rules, develop capital requirements, and make sure that people can participate in all markets.
So I think the experience shows that risk transfer worked and is working now at Fannie and Freddie. And we've also seen private reinsurers pay out about $1 billion to the National Flood Insurance Program during the storm season. And there is even more capacity in the private market for increased risk transfer. Aon Benfield puts the reinsurance capital and de-risking capacity at about $600 billion worldwide. So why not look elsewhere in the federal government? Why not, on the housing front, why not replicate risk transfer at FHA and Ginnie Mae? And why not encourage de-risking for all federal credit guarantee and insurance programs? That was the other question I just wanted to ask in general of the panel. I don't know, Mr. Crone, if you'd care to comment.
Yes, I believe that you need to look at these alternative sources of capital. The reinsurance industry, you mentioned the NFIP, was incepted last year at January 1. In its first year, the program returned the entire limit to the federal government. This year, as it's being renewed, reinsurers have not fled for the hills. They're back and they're having discussions with the NFIP and pricing that now going forward.
Well, with that in mind, I plan to introduce legislation to direct the Office of Management and Budget to identify other areas in the federal balance sheet where de-risking could be used to protect taxpayers. I think it's a strategy that would accrue to the benefit of stability all the way around, and in terms of proper pricing of risk and offsetting moral hazard in this system. But thank you very much, and Chairman, thank you for the hearing.
The gentleman yields back. The chair now recognizes the vice-ranking member of the full committee, the gentleman from Michigan, Mr. Kildee, for 5 minutes.
Thank you, Mr. Chairman.
Rolls off the tongue, doesn't it?
You got it right. You can just say assistant to the regional manager. That's fine. Before I turn to the panel, I do want to commend the ranking member and the chairman for this series of hearings and reiterate what I think has been discussed previously, and that is this is an area of policy where I think the divisions that often manifest on this committee might be able to be overcome. And so I want to encourage the leadership of the subcommittee to continue on that path. Very often I think we imply ideological differences where technical solutions are really at the core of the issue. And as long as we know what direction we're going, I do think there's enough common ground for us to try to knit together some policy that we could all work together on, not 100%, but perhaps at least something that we could present to the full Congress in a bipartisan fashion. So I want to encourage that. It's also very good to see Professor Wachter. We worked together in when I was in real life before I came to Congress. And so it's good to see you and to have you here. I want to follow up a bit on the line of questioning that Representative Velasquez initiated. And not so much dealing with the secondary market or the structure on that end, but actually thinking about how the structure of the market and the way we manage risk could have an impact on certain cohorts of the housing market. And I'm particularly concerned about the impact in weak markets and low-value markets where we're already seeing real difficulty in getting mortgage financing. It's a pretty simple problem we face. And for those who don't know, I come from Michigan, from a string of older industrial cities. It includes my hometown of Flint. And I recall having conversations in this committee about small mortgages. And I do remember, I don't want to throw any member under the bus, but I was crowing about the need for small mortgages. Somebody said, oh, you know, you can get a small mortgage. You can get a $150,000, $200,000 mortgage, no problem. In my hometown of Flint, you know, we're looking for ways to finance home mortgages, $25,000 and $30,000, and we just cannot get financing because the risk associated with that mortgage versus the value of that mortgage on a balance sheet makes it really impossible for a lot of lenders to justify, you know, engaging. So I guess a couple of questions. What impact, well, I guess I'll turn it around the other way. What suggestions can any of you offer that allow us to balance this question of the institutional risk in the marketplace and the need to make sure that we are penetrating with mortgage products into these really weak markets so that it's not just a question of creditworthiness, which is another part of the question I want to get to, but the market in which a person lives with great credit, very often they're locked out of the housing market because they can't get a small mortgage in the size that I'm talking about. Perhaps starting with Dr. Wachter, but I want to go to Mr. Rippert on a couple of other questions as well. Could you comment on that particular issue?
Yes, it's a very difficult problem, and it goes to the question of the lack of supply of mortgages affects the prices. Right. So the very fact that mortgages are not there means that the properties are valued less. That's kind of a reinforcing cycle. And that was the point of the credit of the CRA, Community Reinvestment Act, because the thought is that there are good risks out there, but they're being avoided. There's good lending, creditworthy lending that's being avoided just because of the perceived risk, and that other entities will not come into the market, so that is artificially limiting the pricing of that market. That's a real problem. My concern is that it's a natural outcome of cycles that pricing of capital does change over the cycle, and it does change over place. So if we allow each place to have its own credit risk, and that changes over the cycle, we will basically undo a national credit market, a national insurance market for default risk. That national insurance market for default risk has been very liquid and has efficiently priced interest rate risk, allowing for a 30-year fixed-rate mortgage, and has allowed for credit risk to be priced relatively reasonably. But if we had every size of property, every geography having its own price, that would be very volatile over the cycle. So the problems you describe, which are very real, would become far worse. The way to directly take on your problem is to go back to the concepts behind the CRA and think of revitalizing communities with pools of capital, and that we need to return to, but it's probably a subject of another discussion.
Thank you. I appreciate it. I know the chairman is a pretty good timekeeper. I think I've gone over a little bit. I appreciate the indulgence.
The regional manager yields back. Thank you for that. Listen, it looks like we've had a lot of members come in, but I think they've been pulled away, so we don't have any other witnesses or members to ask questions. But I want to thank the panel for their time. I know you're all very busy people sharing your expertise with us. This is an important space that we want to make sure we get right, and I can guarantee you that we'll all be having additional conversations with you if you don't mind continuing to consult with the subcommittee and the committee as a whole. So again, thank you for your participation today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the chair, which will be forwarded to the witnesses. I would ask our witnesses to please respond in as prompt of time frame as you can. Without objection, this hearing is now adjourned.
Thank you, Mr. Chairman.